just a couple of observations is that there is a capex cycle going on that's raising GDP and government spending, but domestic ordinary businesses in the US are struggling because rates have been high. And so you've got this bifurcation, the domestic versus the internationals kind of thing, as you said. And that's caught a lot of people offsides as just misunderstanding that whole process, when in fact liquidity explains what between 90 and 97% of pretty much everything. You have one macro factor. I've always said that it's the greatest and easiest macro risk-taking environment of all time because you have one macro variable that matters and nothing else really counts.
BitcoinZella stands out with its simplicity and clarity. We've crafted an experience that anyone can dive into, whether you're a crypto expert or just a new to the crypto world. Now guess who keeps his eye on us? The author of best-selling book Rich Dad Poor Dad, Robert Kiyosaki. And we want to take this opportunity and thank all the people who trusted us, and we read every comment. And the best part, it's free. Subscribing now means you will get all new information for free. Don't just follow the trends, stay ahead of them. Subscribe to BitcoinZella today and enjoy the new edge.
Raoul Pal will talk about Bitcoin, crypto cycles, and explosive market shifts. Let's go.
It's always been my impression that the global central banks completely understand what they're doing. Japan is always the leader in this for some because of its population's older, I guess. And there's signal in what they're doing, which is saying they've all seemed to have gone away from using traditional methods to just going straight to the private sector and using the banking system. And Japan is doing the same thing by readjusting its yield curve.
Yeah, it is. And at the same time, we're obviously seeing this global trends towards removing red tape, removing capital restrictions, etc., for private banks, again, incentivizing them to do the heavy lifting on this liquidity creation. And I think that's essentially what a lot of people have missed over the past couple of years, that we've seen a move from central banks doing the heavy lifting themselves to instead incentivizing the private system to do it instead.
Why did they do it?
At least my initial thesis was that, they were scared in the aftermath of that inflation spike in 2022 into asking someone else to do the dirty job.
They can't be hung for it. So it's like, well, we're not doing it.
Therefore, they've incentivized the private system to do it instead. And I think that makes, for as long as we're running inflation above their target range, that's probably how they're going to maneuver this.
Oh, so their messaging looks consistent. It's like, we're not adding liquidity because we understand inflation. Meanwhile, they're like, hey, you guys over there, buy as many of these bonds as possible and create more credit on the back of it.
Imagine knowing a crypto whale's next move before it happens. With AI, that's no longer wishful thinking. It's becoming reality. Traders are increasingly turning to artificial intelligence to decode on-chain behavior, giving them an edge in predicting large-scale wallet movements before the rest of the market even notices. In a space where a single whale can trigger buildings and liquidations within minutes, early detection can mean the difference between profit and panic. AI tools sift through massive volumes of blockchain data in real time, flagging high-value transactions that surpass preset thresholds. But it doesn't stop there. Advanced algorithms go beyond basic filters, identifying behavioral patterns and clustering wallets based on similarities in trading behavior. Whether it's accumulation, distribution, or stealthy moves toward exchanges, AI can map the hidden strategies whales use to stay ahead. By integrating blockchain APIs and layering in sentiment analysis from platforms like X and news sources, traders can build an early warning system that alerts them before volatility strikes. AI turns chaos into clarity, letting traders move from reacting to market swings to anticipating them, often before they even happen.
I wrote about this on X recently. I'm like, it's amazing because I went and searched via Grok or whatever to go and find any use of the word debasement by any media. There was none. Yep. And what's also incredible about the whole debasement trade, it was a bunch of fucking crypto people who figured it out well before everybody else. The gold people had kind of got confused with inflation because they were very stuck in the 70s idea. And it's the crypto people who figured this all out before everybody else. And finally, people are starting to realize that this is the thing. And so I think, as you say, it's still early because I still have to explain it to everybody. And by the time we even get to next cycle, I think it becomes the all-in, everybody knows what the game is.
Yeah, I think you're right. And we started out by discussing the business cycle and where we are in the business cycle. If you look at the best forward-looking evidence for labor, for example, temporary hiring. Of course, you do not hire people permanently when you think the outlook is slightly muddy still, which is, for sure still the base case at sea level. But we're starting to see, a mild acceleration in the temporary hiring while we don't see the hiring elsewhere. And that's the first clue of a reacceleration of the hiring cycle. So I think in a couple of quarters from now, we'll probably start talking about scarcity in various sectors again, and from an employment perspective, also given what's going on with the labor force, right? So my biggest bet actually right now is that the CapEx cycle that we see in data centers, AI, etc., will spill over to a massive CapEx cycle in automation. And those two themes are obviously interlinked.
The kind of robotics idea that everybody gets efficient in manufacturing.
Exactly. So look at it this way: if you see a decline in the foreign-born labor force as we do right now, and you send a lot of low-skilled workers home, if you're a farmer, if you're a warehouser, if you're in logistics, etc., you simply need to spend now to be on top of this. And ultimately, you're more into this than me. I don't think it's out of this world to think about a humanoid robot controlled via AR in India. So you can still hire, but not in the US. And I guess that's kind of what the administration is trying to incentivize early here. So I think it was really, really interesting when I did a study. And typically I hate looking, 5-10 decades back for comparisons, because nothing is kind of like that anymore. But I had a look at the last time we had tariffs implemented in size. And what happened in the aftermath of that was actually a huge CapEx cycle, because by implementing
the 50s.
Yeah, 50s, and then you had an implementation of tariffs just around the 1890s as well. So, you have a couple of empirical studies, and both led to CapEx, because you simply force the local manufacturers to do CapEx, even though they don't want to, especially if you shrink the labor force at the same time.
The cryptocurrency market was thrown into chaos following an unprecedented $19 billion liquidation triggered by a sudden flash crash. In the middle of this turmoil, one mysterious trader managed to secure a staggering $88 million profit by shorting Bitcoin, just 30 minutes before the US announced a 100% tariff on Chinese goods. The perfectly timed trade immediately sparked suspicion across the crypto community. According to analyst Vivek Sen, the account behind the short was created the very same day, raising red flags about potential insider activity. The news spread rapidly, with prominent attorney John Deaton calling for a full investigation. Many in the community believe the trader may have had access to privileged information, especially given the precision of the bet and the sheer scale of the liquidation event that followed. Bitcoin, which had recently surged to an all-time high above $125,000, collapsed by over 12%, dropping below $113,000. As of now, it trades around $112,385. Data from CoinGlass revealed that over 7 billion in leveraged positions were wiped out in just 1 hour, affecting more than 1.6 million traders worldwide in one of the most violent sell-offs in crypto history. If you have been watching so far, thank you so much for watching. And do not forget to subscribe to Bitcoinzilla for daily news all for free. That's all for today's video. Until next time.